Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now, Yardeni of Yardeni Research. He writes Trump and Besant discarded some of their best cards while preparing to play tariff poker with China. Financial markets are happy that Team Trump is blinking. Yardeni joins us now for more. Ed, welcome to the programme. Let's talk about the extent of that blink. How much of a U-turn are you expecting in the next several weeks?
Well, it's a very odd situation where the United States seems to be negotiating with itself. It's a very peculiar art of the deal where you walk in the room and you're the only one in there, and you keep issuing press releases saying that great progress is being made. So I don't really know what to make of it. What I do make of it is that clearly the financial markets have had a big impact on the administration. This is the bond vigilantes and the stock vigilantes ganging up on the administration and saying, we need some moderation here. We need some cooling off, and that's exactly what the administration is doing.
And Ed, it's the Target, Home Depot and Walmart vigilantes as well. Clearly the most important meeting that took place in Washington this week were the retailers sitting down with the President of the United States and warning him that within weeks we could have empty shelves. And Ed, I think it makes it difficult at this moment to read the economic data. What is a genuine rebuild in inventories? What is a genuine sustainable underlying trend in demand? Ed, what do you see in both the data and the earnings?
Well, the earnings are actually starting to be cut back, of course. Analysts have finally gotten the recession tariff memo. So they've started to incorporate the fact that this isn't going to be good for the economy. It's going to weigh on the economy. I think to the extent that, analysts usually talk just to companies. They don't talk to economists. But they're reading the headlines and they see that economists are lowering their outlook for economic growth, and they're probably getting that kind of guidance from some of their companies that if the tariffs stay on, the longer they stay on, the weaker the economy is going to be. But I think at the rate at which the administration is backing off here, the economic impact of the tariffs could start to really ease off by the second half of the year, which is at this point when most economists expecting a much weaker economy or actually a recession. So there could be a reversal, at least in the soft data, that then would suddenly lift the pressure off the hard data.
And it feels like the genie is sort of out of the bottle, but we can't see him. We don't know how big he is. We don't know whether he can climb back into the bottle at any given time. I just wonder, as you look forward, why you reject the idea that what we're seeing right now is a long-term structural loss of U.S. exceptionalism that will result in a weaker dollar and potentially less dynamism in U.S. equities over time.
Yeah, that's a great question. I mean, it's only a few months ago that the American exceptionalism made the front cover of The Economist. I think it was October of last year. There was a wad of dollars that looked like a rocket ship, and, we couldn't be stopped. Look, I think now that everybody's having second thoughts about that, or even concluding in a dire way that the dollar's is in decline here as a reserve currency, keep in mind that there's nothing like the U.S. capital markets. When you make a list of exceptionalism, American capital markets are exceptional. They are huge. They are liquid. There's nothing like them. So I don't know how the dollar loses its reserve status. And I think it remains strong. Even this recent hysteria about the weaker dollar, it fell about 10% using the dollar index, the DXY, that everybody watches, but a much better index that the Fed calculates is down about half as much, which is no big deal in my opinion.
Ed, this is the reason why people are looking at announcements from a number of different asset allocators and seeing if they are trying to diversify even a little bit away from the United States into other countries. I just wonder how concerned you are about the idea that 44% of S&P 500 companies that have reported so far have mentioned the word recession. It's up from 3% in the fourth quarter at a time where potentially the U.S.'s ability to borrow to bolster the economy in any kind of downturn could really be a lot more difficult, a lot more pricey, a lot more punitive.
Yeah, well, I think the stock market's discounted certainly a weakening in the economy in the second half of the year. We certainly lowered our numbers from something like 2.5% to 3% growth this year to something more like 0.5 to 1.5%. The only question is whether there should be negative signs on those numbers, and some people, I guess, are in that camp. We're still looking at a 45% odds of an outright recession. We think the administration is going to back off as they have been on these tariffs. And to the extent that they don't, I think they're going to declare victory. I think they're going to get maybe 90 pieces of paper from 90 countries signed by key diplomats laying out a groundwork, a framework. You can't negotiate a treaty in 90 days. You can't implement the treaty in 90 days. But I think they're going to declare victory and move on to the extension of the tax cuts, and life will go on.
Ed, when it comes to the tariffs, though, the Wall Street Journal reported the administration might back down on China to, say, 60%. But that is what Trump has been saying for months. On the campaign trail, he promised 10% across the board, 60% on China. So if that's the base case, how does this economy look?
Well, as you know, it's hard to define what the base case is. It changes almost daily from the press conferences that the president has in the Oval Office. His associates keep talking about how much progress they're making. So I think 60% is just as prohibitive as 145%. I think they're going to have to again negotiate against themselves and maybe postpone that increase. So they'll leave it at 60%, but they're going to postpone it for 90 days. Turn down the rhetoric and find somebody to negotiate with the Chinese on a better deal.
Ed, just a final question from us. You've been super constructive on this cycle for quite a while. Coming into the 2020s, you talked about the roaring 20s.
Yep.
We're at the halfway point, working through that now. Ed, have you thrown in the towel on that view, or are you sticking with it?
Well, John, it was a great first half of the decade. I hope it's the roaring 2020s isn't over yet. There's sort of deja vu with the 1920s. We got a whole decade out of that before the Congress horrendously imposed tariffs. So there's a certain similarity here, but I think this too shall pass. And I'm still looking for the roaring 2020s to be a description of the entire decade. Call me an optimist, but I think, I guess my mantra has been, look how well the U.S. economy has done over the years despite Washington. And that's still my bet.
Ed, we hope you're right. It's good to catch up with you, sir, as always. Ed Yardeni there of Yardeni Research. To discuss, I'm pleased to say that Norges Bank Investment Management CEO Nicolai Tangen joins us now for more. Nicolai, welcome back to the program, sir. A lot has changed since we last spoke. Attitudes towards US assets are starting to shift. I just wonder how you and the team have started to think about that, how you're debating that issue internally over in Norway.
Well, we have a very long-term view on what we do. So, we are invested with roughly half the fund in the U.S., and we are here for the very long term. So we have not made any major adjustments lately.
So, Nicolai, can I read into that you view this as just a shock to the cycle and maybe not a long-term shock to the system?
Well, I think it's very, very difficult to say, because when we make scenario analysis here, one of the negative things that we see is that if you get a disentanglement between the two major trading blocks, that's really, really negative, because it slows down growth, increases inflation and so on. So it is potentially one of the really negative things that can happen here. So I think the outlook for markets are very, very uncertain.
Given that there has been a shift, Nicolai, to move at least a little bit of assets among large asset allocators out of the United States and diversify to places like China, to India, to Europe, why aren't you doing the same and shifting to benchmarks that have a little bit more exposure elsewhere?
Well, we actually are extremely well diversified already. We own 1.5% of all the listed equities in the world. In Europe, we have more. We have close to 3%. And so In the US, we have 1.5%, and we also have the same in the rest of the world. So I would say we are well diversified, 70% equities, 30% bonds, and we also have a very, very good real estate portfolio, which is coming in really handy here.
Well, Nicolai, you said previously this morning when you were speaking to media in Oslo that you will correct the underweight to U.S. stocks. So you are planning to reinvest in U.S. stocks, even though you are surprised that we haven't seen even more weakness. Why are you redeploying all of the money that maybe has lost in terms of benchmark allocation to U.S. equities, given some of these larger uncertainties?
Well, the kind of the increased allocation to the U.S. is part of a program that we've been doing for quite some time. We still have some work to do here, and that we will continue to do. And we think the large American companies are just great long-term investments, and so we are very happy to be invested there.
What sectors? Can you give us a little bit of a hint of specifically the sectors or the companies you're interested in the United States?
Well, we are quite index near in how we are invested in the U.S. So we typically have large holdings in the big tech companies, in all your large companies really, and we made a lot of money there over the last few years. Of course, so far this year it's been negative, but when you look in comparison to the gains we've had the last year and the year before, we've given back in a way surprisingly little, I would say.
What about defensive companies like Lockheed Martin? Is that going to be open for business when it comes to the sovereign wealth fund?
Well, we invest in a lot of different industries. We have less exposure to the defense industry, but we are in a lot of the defensive names as well.
Nicolai, one word you often use with us is we are diversified. I just wonder if the meaning of that word has shifted over time, particularly this year. The Treasury market is behaving in unpredictable ways. When the equity market is falling, Treasury markets have fell as well. In fact, those two asset classes are trading in lockstep at the moment. It's as if investors are treating all dollar-denominated assets as one bucket. And I just wonder, Nicolai, what that means for how you think about diversification this year and beyond.
Yeah, there were some times when this type of diversification worked less well. We had the same type of situation, 2-3 years ago. And so some years it works, some years it doesn't. I think over time, if you have a really long-term time horizon, I think it's the right positioning to have.
We've seen over the last month or so that some investors were trying to understand whether what was happening in the Treasury market was just trades unwinding, some hedge funds blowing up, or Nicolai, whether it was a reassessment of the safe haven status of the United States. Nicolai, what's on your dashboard to help distinguish between one and the other? What do you think it was? What do you think it is?
Well, I think it's a very, very complicated question. I don't think it's only one thing. I think it's a cocktail of all the kind of things you mentioned. Now, so far this year, we have been neutral to the U.S. Treasury market. We have not reduced or increased positions, so we have certainly not caused that move.
Do you have a sense, Nicolai, going forward of whether we are entering a more inflationary period given some of the deglobalization that we're seeing, some of the fissures and some of the kinks that are emerging in the supply chain system?
Yeah, I think we are potentially going into a more inflationary situation. It is kind of a pretty obvious consequence of higher tariffs. And of course, inflation is really negative for markets. So I think that's potentially one of the big risks that we are seeing just now. Interestingly, we just yesterday released a podcast with Ken Rogoff, kind of the world leading specialist, I guess, on inflation. And he's also very worried about this particular fact.
Well, I guess that just to build on what John was asking about, the idea of diversification, and you have been about neutral on U.S. bonds, there has been a feeling that maybe diversification, especially in an inflationary environment, requires some gold, requires some alternative assets that might be asset-based funding that have different streams of diversified revenues. Is that your take on it, that you just on the margins want to pick up a little bit more gold or diversify a little bit more in some of these other asset classes?
Yeah, so we have a very strict mandate here from the ministry. So we cannot buy gold, and I do think gold sometimes is a bit difficult to understand what the intrinsic value is of gold. We also don't do cryptocurrencies, for instance. But when we look at alternative assets, I would say in a market like this to have real estate, that's very good. We have just under 1,000 properties around the world, large holdings in Manhattan, Boston, Washington, and so on. And so I think that's going to be a pretty good place to be going forward.
Nicolai, appreciate your take at a difficult time. Thanks for your time this morning. Nicolai Tangen there, the Norway Wealth Fund CEO, on a difficult moment. The ECB warning tariffs may be more disinflationary than inflationary for Europe. This after President Trump said he's confident of reaching a trade deal with the EU. Joining us around the table here in our studio in Washington, D.C., the Chief Economist of the European Central Bank, Philip Lane. Philip, it's good to see you, sir.
Good morning.
Thanks for being with us here in Washington. So the Governing Council meeting, I imagine, was very different this time around than a number of months ago. When you walked into that room and presented changes to the economy, what did you tell the team?
Sure. I mean, I think it was a gear change for several reasons. So, of course, our core business has been to try and get inflation back down from a high number to our target. So I think there was a milestone in this meeting in the sense of the most recent data had come in quite low. We'd been waiting for services inflation to kind of drop, and it has been dropping. And then we had surveys showing that basically the wage dynamic this year and in 26 is lower than we expected. So basically, if you clear the table about the historic issue, are we safely bringing inflation back to target? I think it's not entirely settled, but a lot of it is settled. So the gear change was, of course, now we have new things to talk about. And really, since all the way back to last summer, trade policy uncertainty has been part of what we've had to talk about. But we still have trade policy uncertainty, but we also have trade policy news. Lots has happened. And then the other element of what we've seen is, of course, and that happened, by the way, like a day or two before our March meeting, was the German breakthrough on fiscal policy.
Yep.
So we already had that, if you like, in the early incarnation at the March meeting. We know more now, but it's still, in terms of what the other European countries are going to do, it's something that's still in discussion. So what I would say, if you put all of that together, and I think you're probably hearing this from various colleagues and other people this week, is if I take a longer term perspective, and the IMF in their publications this week, a lot of the data go out to 2030. If I take a 2030 perspective, I think there's a lot of grounds to have a renewed optimism that essentially with more fiscal support, the credibility of delivering our 2% target on a kind of long-term basis is stronger. The case for the European economy to be more resilient, to grow from a domestic source, not just from running a big export machine, is more credible. But of course, we have to navigate from where we are now, where, as you said in your intro, immediately in the short term, the way it's playing out, with euro appreciation, with a big drop in energy prices, the disinflationary forces are there. But I would say maybe the question, I wouldn't load it all onto trade policy.
Sure.
What we also see now is a portfolio shift. So there's a clear portfolio shift going on, which is, I think, the way you can reconcile euro appreciation in the middle of this trade discussion.
As you know, Philip, that sort of begs the question why you don't act more aggressively. Does that give you the space to act more preemptively?
Well, I think a very important narrative we had last week, and it was repeated throughout the monetary policy statement, was resilience. What we're seeing is the European economy growing. 2 years ago, it was kind of more stagnating. So we said the European economy is going to recover. We saw, modest but still market recovery last year is around 0.9. We have 0.9 written down in March for this year. And that's basically because with incomes going up, consumption should recover. With our monetary policy and the general improvement in the economy, investment should recover. With more government support. So all the domestic engines are there. So what you have to think about is all of that, if you like, is saying the economy is should be growing, even marking down some trade negative. And this is why we're not in a situation where we see some dramatic change in the external environment or in price pressures and so on. So steady is okay, I think.
Hold on a second. Are you saying that what we've seen with respect to U.S. policy and the uncertainty isn't increasing the chance of recession materially for the euro region?
Well, I mean, I think our overriding theme, of course, is uncertainty, and let's not get ahead of ourselves in terms of being too sure about any path for the economy. But I think the message is, but it's not me dreaming it up. If you look at the external watchers, if you look at the IMF, it's fairly modest markdowns on the growth rate for the European economy. The US, of course, has a major trade policy issue with the world. We have a trade policy issue with the US. The US is an important trading partner, but it's not our only trading partner. So directionally, it is a markdown. There is a markdown, but it's important to say it's a markdown from a growth rate around 0.9 to a little bit less. Let's see in the coming weeks how much less. And I think if you look at the surveys this week, the surveys have elements of people being concerned, but they also have elements saying right now we're busy. Manufacturing is a bit busier than it was. That could be a little bit of front-running of tariffs, for sure. But it's also, remember, the recovery narrative. Europe has been stagnating. The American economy has grown quickly. So if you like, in terms of if there was room for the American economy to decelerate and then trade policy is adding to that, what I'm saying to you is essentially the baseline for Europe was to grow a bit more quickly. And so the resilience is there. You can take a trade hit without going to using that word, which that you mentioned.
You mentioned, of course, that Europe has more trading partners than the United States. How concerned are you that if the walls keep going up in the United States, China will have to just dump somewhere, and it's going to be on the continent?
So I think directionally an element of that must be expected. But I think China fully understands that if you listen to their policy announcements, their focus is on improving domestic demand. So in terms of the reorientation from the US, I would allocate a fair amount to domestic demand, some amount to around the world. But I think also China understands it's a large economy and a bit of restraint in exporting may make sense.
Philip, I've got 20 seconds left. I just wanted to jump in. Ollie Rehn was busy this morning, your governing council partner, and he made the point that we should be open to larger interest rate cuts. Is that a position that you and the team agree with?
Philosophically, we don't pre-commit to any rate path.
Of course.
And so this is why, again, it's important, and I think the governing council, tries hard to maintain this, is you can express that in different ways. And in particular, there's no reason to say we're always going to do the default of 25. So philosophically, I agree with that. Okay. But what I said to you earlier on is right now, the growth performance, I'm sure to be marked down. Yep. It's still a growing economy. We have inflation, I think, to the downside. But we don't need to be too dramatic about it.
Equity futures right now in the S&P just a touch softer. We're down by 0.2%. Coming up this hour, Franklin Templeton CEO Jenny Johnson following back-to-back gains for equities. We'll catch up with Carlos Cuerpo, the Trade and Economy Minister of Spain, on a US-EU trade deal, and the Standard Chartered Chair, Jose Vinales, on the potential for lower levies on China. We begin this hour with stocks lower as investors await clarity on trade talks. Jenny Johnson, the CEO of Franklin Templeton, one of the world's largest investment managers, joins us now for more. Jenny, it's good to see you.
It's great to be here. Thanks for having me.
Things have changed a lot since we caught up with you in Davos, Switzerland. There's a lot of optimism. You remember it. Everyone was charged
US
up.
Exceptionalism.
Bullish growth, lots of hiring, markets are great. Things have changed a lot. How have they changed for you?
Well, we talked about it at the time. I think that you have to think through kind of where the president is, right? He's come in with a plan, and he's been very clear, right? It's taxes, immigration, tariffs, government efficiency, and deregulation, right? And he has about a year and a half to get those things done before the midterms come in. And so, from the tariff standpoint, again, he's a deal maker. So when you are trying to make a deal, you need to show that you are in the position of strength, right? So a lot of this blistering is around, I'm in a position of strength and you're going to have to bow to my will. I think the challenge has been there are some unintended consequences of that. I was talking to somebody yesterday about Canadians. They're not so upset about the tariffs. They're upset about the 51st state comment. And that Airbnbs in Rhode Island are down because the Canadians say, I'm not going to come visit the U.S. So those are the unintended consequences. The other piece of this is he needs the tax revenues identified in tariffs to help fund his tax cuts, which, by the way, are not tax cuts, really. They're extensions. And if we don't get that extension, there is a massive tax increase that happens, which really becomes an issue around the economy.
Can you describe how you and the team think the end game looks like? What do you think it looks like? Because some people have described the last few weeks as madness. Is there a method to it?
Yeah, so I think what we hope to see, right, you'd like to see a couple of deals done, right, to show that he's willing to come to the table and make a deal, right? So if we can see a deal with Japan or Vietnam or, somewhere to show, no, he's playing his deals. You'd like to know who is responsible. Remember, it was Paul Ryan who ushered the first tax cuts through. Like, who's responsible for ushering that legislation through and championing that? That'll be very important because he's got to get those done. And the question is, how quickly can he get it done to calm the markets? Because what we've seen is, look at you, when you suddenly have CEOs who say, I can't give guidance because there's so much uncertainty, that uncertainty makes them fear, and then they stop making investments. If you stop making investments, it slows down the economy, right? So I think what we need to see in the next 90 days is some clarity.
In the meantime, uncertainty leads to a lot of conspiracy theories and lots of other types of speculation. As someone who oversees $1.5 trillion of assets, how much of a material shift have you seen with customers, consumers, shifting just slightly away from U.S. assets to insulate from some of the whipsawing and the uncertainty?
You definitely see non-Americans reducing on the institutional side some of their exposure to U.S. equities. Okay, so we've seen that a bit. But on the other hand, you sort of, if you are in the market now, this is not the time to get out of the market, right? You need to play this out. And if you hadn't made the trade to being in more defensive stocks, then there's no point in doing that now, right? Because you've already sort of missed it. So, the reality is AI. I actually played around this weekend with an app called Replit, where you can just use natural language processing to have it code and generate an app for you. Like, the efficiencies that are going to come from AI, we haven't seen those kind of productivity gains yet. The productivity gains that we're seeing are coming from technologies that came out 20 years ago. And so as those things play into companies, I think you'll see real opportunity.
One thing that I hear from you, and I heard from Mike Wilson of Morgan Stanley earlier this morning, was that corporate America has a lot of good about it in terms of strength, in terms of resilience, in terms of technological progress. It's the question about other dollar-denominated assets, and I'm talking about treasuries. I'm talking about government debt, especially given some of what you were talking about with respect to who is driving some of these budget proposals through Congress. That really is the issue. How much have you seen that bid get called into question as institutions, particularly foreign ones, move away?
Well, I think there's a question of, how much are, foreign governments pulling away from treasuries, and, is that what we're seeing in the treasury market, or are we seeing the unwinding of the basis trade? And so, look. Then the question falls into, well, is the U.S. as the reserve currency a question? Look, where else are you going to go, right? The U.S. is going to be the reserve currency. People will say, well, China trade has gone up 50%. Yeah, it's gone from 4 to 6% of trade, right? It'll chip away at it, but we are still going to continue to be the reserve currency.
You mentioned a lot of non-U.S. investors pulling back from the United States. Morningstar had research out this week that said some of that is actually patriotic rebalancing from capital from America to Europe. Do you think it's that emotional for some of these people?
Well, just again, talking to folks from Canada who are so fundamentally offended by the comment of, the 51st state, yeah, it's emotional, right? They kind of get it on the trade and tariffs, and we can deal, and you want help on immigration, but a comment like that has obviously had that kind of nationalist response.
What are the long-term impacts of feelings like that?
Listen, I was at a dinner last night. We were, debating, does that push Europe to China? No, I don't think it, obviously I think what it does is there's the joke of, it's not MAGA, it's mega, make Europe great again, right? It forces Europe to do things like more defense independence, more energy independence. Look, there has been a lot of brilliant talent in Europe. Why are we not seeing these unicorn companies from a technological, and a lot of people would say it's the regulation and it's some of the policies that they have in Europe. And so if this forces Europe to be more resilient on its own, that's actually a good thing for Europe. I don't think they don't suddenly trust China much more. They're already trading with China. But it forces them to say, you know what, we have to stand on our own a little bit more.
It's why we've seen some investors rebalance towards Europe since the start of the year. I wanted to build on some of Lisa's questions, and I think this is an important line of questioning. At the moment, some investors aren't drawing a distinction between risk assets in America and the safe haven asset in America. It's trading as one bucket, dollar-denominated assets. And I wonder from your perspective, when that EM dynamic starts to take hold of a country, whether that's a risk you need to actively manage or a dislocation you take advantage of. Which one is it at the moment?
Well, I think anytime that it becomes a risk-on, risk-off in a big block, and yet the underlying fundamentals are different in kind of an investment, that actually becomes a great investment opportunity. So I think you have to look at it and unpack those.
Do you think that's what this is right now? And is the opportunity in stocks or bonds with that in mind?
I think right now it's almost a market reacting to just a headline statement, right? And so it's really sort of on and off. It's a risk on, risk off. I think that from the dollar was some would say overvalued, who knows, right? And it's come down a fair bit. I think there are a lot of people that were the U.S., the debt and the deficit, thought that it was overvalued. And so probably in this, there's a little bit of that coming, some of that frothiness coming off.
What's your advice to people right now who were part of that dollar bid? They've built up that massive dollar long over the period of a decade across asset classes in both equities and fixed income, and they're nervous about the policy in Washington and looking to reallocate. What are you suggesting they do?
I think it depends on where if you're a dollar-based economy, I think that's okay. You don't have to worry about that. If you're not a dollar-based economy, you have to understand how that's going to impact your investments.
Certainly been something the Europeans have had to think about over the last few months, that's for sure. Jenny, it's good to see you. Lots to talk about. I can't imagine how much has changed the next time we speak. Jenny Johnson there, the Franklin Templeton CEO, on the latest in this market.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.